All right, everyone, it's 2 o'clock, so we're going to go ahead and get started. The first couple slides are really just some instructions for today's session. And first, just please make sure that you can see the slide, see the content. Make sure your speakers are on. I am speaking right now, so if you can't hear me, please reach out to us and we can help you out. To adjust your audio, there's a little bit of instructions here. And if you are here for some CPE, like I said, there is a Conferences IO button at the top of your screen. Please sign into that. And there's also a QR code that's been put in the chat for CPE as well. There's going to be 4 polling questions today, so keep an eye out for that. And just make sure that you answer the polling question. It doesn't matter what answer you choose. As long as you answer, you'll be in for CPE today. So this is our normal disclaimer slide. We have that at all of our presentations, and it's just saying this presentation is for general educational views and content, and it pretty much is just saying any statements and opinions are mine today, not necessarily the Bonadeo Group's. And these slides are accurate as of today. So we all know in the accounting industry, things change constantly and everything moves at a rapid pace. So what we're talking about today does have the potential to change in the future. And hello, good afternoon. So a little bit about me. My name is Heidi Bresler. I'm a partner here at the Bonadeo Group. I've been at the Bonadeo Group for pretty much my whole career, so that's around 18 years. It's a long time. Time certainly flies. It goes by quickly here at the Bonadeo Group. During my time here, I've been really focused on accounting and auditing of nonprofit and governmental organizations. And I've also really focused on compliance, Yellow Book, federal funding, and single audits as well. I'm a partner in our Excellence and Quality Group, and we're responsible for financial statement reviews, the quality control process, education, both internal and external, and certain risk management responsibilities as well. Recently, I joined the AICPA's Governmental Audit Quality Center Executive Committee, and in that committee, I talk about grants and federal funding requirements and other types of Yellow Book and single audit requirements with other CPA firms and the AICPA at a national level. Just some general information also about today's session. So the presentation materials and the links to the webinar will be sent via email to everybody who's attending today within 2 weeks after this event is over. And if you haven't registered for the remaining sessions in this series, there's still time. So we're going to post a link in the chat, and you can go ahead and click on that link and sign up for any of the remaining sessions. We do hope that you take advantage of this series. There are some really great presenters, some really great content throughout the week. So if you can attend, I definitely encourage you to attend and check out the remaining sessions and the content throughout the week. If you have questions today, feel free to put them in the chat. There are some slides where I may say to put something in the chat if you feel comfortable. So if you do feel comfortable and want to engage with some of the content that is in this session, please do put in some of your responses, some of your thoughts into the chat after I prompt them with certain slides. We have a full agenda for the session today, and I'm excited to talk to you about the current state of nonprofit organizations. So we're going to take a look at the economic, kind of what's going on in the world, what's going on in the United States, and how that impacts not-for-profit organizations. And then we're also going to dive into some nonprofit trends and challenges. And of course, we're an accounting firm, so we're going to take a look at some of those new accounting standards that have recently been issued and some of the kind of lessons learned from the leases and the CECL standards that have recently been implemented, but we continue to get questions and some questions about those types of standards. So we're going to focus on that as well. And last, we're going to take a look at some common frequently asked questions about nonprofit financial reporting. So in the United States, there are around 1.8 million nonprofit 501c organizations that were reported in fiscal year 2023. And you can kind of see on the slides, although it is a little bit difficult because the type is pretty small, there's a lot of different organizations that make that up. And what's interesting is for nonprofits, a lot of people think that revenue is mainly grants and contributions. But according to the data, a lot of the revenue is actually earned in a typical nonprofit organization. So, for example, revenue like memberships or fees earned for services, that types of revenue normally accounts for around 50% of total revenue for a typical nonprofit organization. Grants and other federal contracts or contributions account for around 30%, and then around 14% of revenue comes from donations for the typical nonprofit organization. This slide is talking about GDP, so that GDP is the gross domestic product. And what that is a key economic indicator in the United States. And usually it's used to gauge the economic health of how is the United States doing at a certain point in time. So you can see just through the United States, of course, in the first quarter of 2024, GDP increased around 1.6%. So that was a smaller increase that was seen in the last quarters of 2023. So what does this mean for nonprofits? What does GDP really have to do with nonprofits? So you can see here that nonprofits' contribution to GDP growth was less than in other sectors in 2023, and again projected to be in 2024 as well. So nonprofits really are focused on missions. They don't have a profit motive, don't have a profit organization necessarily. So they operate in sectors like healthcare, education, social services. So those industries really aren't reflected in the traditional GDP metrics. So that while that may be smaller, nonprofits very valuable to the long-term health and economy of the economy. There's a lot of long-term benefits and services that nonprofits can provide, and only nonprofits can provide with their missions. Inflation is one of those marks we're all used to by now, so we can all feel the effects of inflation at the grocery store and at the mall. Prices are going up. Inflation is one of those marks we always hear about on the news, on different organizations talking about economics. And of course, inflation has something to do with nonprofits as well, right? Because every organization can feel the effects of nonprofits. And according to leading economists, inflation is still pretty high. And I think, again, we can all kind of feel that, but it is easing slightly according to the most recent data. Also, interest rates are remaining high, so this impacts the cost to nonprofits to borrow funds for expansions and capital improvements, as well as for other reasons also. And since inflation is remaining stubborn, so inflation is remaining up there, just like interest rates, experts are now saying that the Federal Reserve will probably not cut interest rates any further in 2024. The leading economists are saying that the first time we'll see any relief with the interest rate reduction is in September 2025. So that's a little ways off to feel some relief in that area. So this slide's kind of interesting. It's showing how, what the nonprofits make up in the workforce here. So nonprofits really only make up around 7% in the workforce, but in terms of employment, again, this is one of the long-term benefits that nonprofits provide um, to the economy. The nonprofits have seen a huge amount of growth, almost 33% growth in employment from 2006 to 2021, more than any other industry. And in general, nonprofits are, that huge source of employment, huge benefit to the US economy, and they provide jobs in communities that may not otherwise see such improved economic activity. So nonprofit employment has historically been more stable than for-profit employment. It's not quite as impacted by recession. And I'm not sure if that's been your experience as well as a nonprofit organization. But the nonprofit employment, again, has steadily grown, has seen significant growth in the past couple of decades, and that is continued to increase or continue to project it to increase over the next couple decades as well. 2023 saw modest declines across fundraising metrics here. So you can see on the slide that the donor counts and the fundraising counts have decreased slightly around 5%. And that's continued to be a declining trend since a peak growth in 2020. So you can see on this graph, this is the part of the presentation where we're talking about economy, and economists love graphs, so you can see there's a ton of graphs here. But on this graph, you can see 2020 was really the only positive year with the donors' growth. Again, having to do with the pandemic and different initiatives that were going on around that time. However, since that time, there's been a decline in the fundraising efforts and in different donor counts that have been going on in the United States. So what has your organization experienced? If you feel comfortable, you can go ahead and put your experience into the chat if you're comfortable with that. If not, that's okay too. And this brings us to our first polling question. So if your workday was a movie genre, what would it be? An action-packed thriller, a comedy, a drama, or a documentary? Very good. So we will go on here with nonprofit trends and challenges. And please do go ahead and put it into conferences IO so that you get your CPE. Just make sure you answer any one of those answers here. I think for me, it would probably be a comedy. Every day is a little bit different. Every day is kind of funny. But again, just kind of put it into conferences IO and make sure you get your CPE. So that brings us to the nonprofit trends and challenges. And I see a couple people are having a few technical difficulties, so we'll make sure we reach out to you and again, kind of check the messages in the chat from my Bonadio colleague. So this section is a kind of a shorter section. We're talking about nonprofit trends and challenges. So in this section, this slide is, again, very interesting. And this is from polls that were taken throughout the United States. And this lists the top 5 challenges in the nonprofit industry. And you can see there the rising operating expenses, again, has something to do with inflation that we talked about a couple slides ago. but rising operating expenses, lack of resources, staffing capacity, difficulty recruiting and retaining quality staff, and economic downturn and inflation. So, does that ring true for you? What's your biggest challenge? Feel free to put it in the chat if you want to share. And again, if you don't and you want to think about it, kind of keep it to yourself, that's okay also. Every day, there are changing regulations and compliance issues. Somebody mentioned in the chat there's a federal freeze going on in the moment with federal programs. That's true. So as you can see, compliance requirements are very complex and they're changing from day to day, and they're really hard to manage sometimes. So we're going to talk about just a couple of the changing regulations and compliance issues that nonprofits may face. For example, there have been some new Department of Labor rules related to the Fair Labor Standards Act, and there's always some guidance that continues to be issued and changed, and again, difficult to manage about employees versus independent contractors, and what does that mean from a legal standpoint, from an IRS standpoint. And there are rules that continue to change with this section. So here there are some rules that emphasize determining whether these employees are economically dependent on an employer for work. So there are 6 factors on the slide that are listed. So you can kind of see them, apply them to your own situation. There could be more factors than this as well, but these are the most common factors that people use, that general counsel would use in determining if if a person is an employee or considered an independent contractor. A growing trend in the nonprofit industry is a fiscal sponsorship. So, what is a fiscal sponsorship? A fiscal sponsorship is where it's an arrangement where a nonprofit organization or the sponsor provides legal or financial oversight to another entity or project that doesn't yet have its own tax-exempt status. So a fiscal sponsorship is the process of using the exemption of another similar not-for-profit in order to run the program. But really, you don't have to worry about the administrative pieces. So you can see with these charts here that fiscal sponsorships is a growing trend here in the industry. There are a lot of different Google searches for it, and just a lot of nonprofits that are looking into the possibility of what is a fiscal sponsorship? Is it right for me? Does it make sense for the situation? So, where a not-for-profit organization may not incur those administrative challenges and those administrative costs of a certain program, there are some risks also that have to do with the fiscal sponsorships. So fiscal sponsors could charge up to 15% of revenue that are flowing into the project. And there is a possibility too that a nonprofit would lose control over that project due to the sponsor taking over the control of that project. And again, this type of situation may have other reporting implications on the Form 990 as well. However, despite these challenges, despite these risks, there has been some interest in and use of these fiscal sponsorships has been growing steadily over the past 20 years. So this is something sometimes we provide consulting with our clients over, is this right for you? Is this a good opportunity? Or should something else be explored? And this brings us to polling question number 2. It's pretty cold outside and pretty snowy where I am, so I'm sure everybody's kind of in different areas right now, but it's always a good time to think about vacation. So what's your favorite spot to go to for vacation? Do you like a beach resort, a cozy mountain cabin, a staycation, or do you like something else? I'm a cruiser. I like to go on Royal Caribbean cruises. I was just talking to one of my colleagues about that earlier today. So I'd prefer a cruise, but what's your favorite vacation spot? It's always a good time to think about vacations. See some good responses in the chat. A cabin in a mountain. That sounds wonderful. So now we're going to talk about the accounting standards a little bit. So there were two very significant accounting standards that were issued over the past couple of years. And again, thank you. That just a reminder in the chat that if you do want to receive CPE credit, please make sure that you are answering the polling questions. So for leases, this is a standard where it's very complex and we continue to get questions and go through different scenarios with our clients. And again, if you do have those questions, we encourage you to be proactive. Reach out to your Bonadeo representative, reach out to your Bonadeo engagement team. We're happy to talk about those types of questions with you. So the LISA standard became effective in 2022. It's very complex. A question that we see often is the discount rate. So do we need to change the discount rate every year? Is this something that we need to think about, every year, every cycle? And the discount rate for leases is one of those things that we'll just kind of set it and forget it. And it may change if there's a lease modification or if there's a lease termination, then we may have to look further into the discount rate if something has to change there. Another question that comes up a lot for not-for-profit organizations is the below market leases. So sometimes a for-profit organization may pay an amount that is lower than market value. And in that case, again, it's very, dependent on the situation that you're in. But if a not-for-profit organization is paying a lease that's significantly below market, there may be two points to recognize that lease. So we would recognize the lease in accordance with ASC 842. And then we may have a contribution also to recognize on top of that below market lease. Another question that we get every once in a while is about leasehold improvements. So the leasehold improvements accounting changed under ASC 842. It used to be the shorter of we used to have to record the amortization related to leasehold improvements over the shorter of the lease or the life of the asset, unless the lease transfers ownership of the asset. But now we record the amortization of those leasehold improvements over the life of that asset. And if the lease ends early, the asset may have to transfer. Another very significant accounting standard that was just released was the CECL model. So this has to do primarily with the accounts receivable and recognizing that allowance for credit losses, which used to be called allowance for doubtful accounts. So previously there was a incurred loss methodology. So we would recognize the losses that when they were incurred. However, under the CECL model, we need to estimate the losses more with a forward-thinking methodology. So under the CECL model, there's a lot of different items that we would need to consider. But expected losses under the CECL model would be based on historical experience, current conditions, and then reasonable or supportable forecasts. What's going to happen? So some questions we get with nonprofits is, does the CECL standard apply? And the answer is yes, the CECL standard does apply to nonprofit organizations. So on the slide here, you can see there's many different accounts that are impacted by the standard. So loans receivables, trade receivables are the most common. And those off-balance sheet credit exposures, again, also should be considered under the CECL model as well. For nonprofits, there's a scope exclusion for promises to give and most grants receivable if following the contribution model as well. So it's really good to kind of review your balance sheet accounts and try to figure out if the CECL model does impact those accounts. And we're a couple years in here on the standard, so I'm sure you're well on your way to be documenting this standard. But always consider new accounts and new line items on the balance sheet to see if they're applicable with the CECL model as well. This slide describes some disclosure considerations with the CECL model. So normally for every standard, there's a lot of different guidance, and then there's some disclosure requirements as well. So this slide is talking about how it's a required element of the CECL standard to group those financial assets with similar risk characteristics in the disclosure. So there are some examples here on the slide: asset type, geographic location, or industry. So typically in the financial statements, we see the disclosures and the risk characteristics that are grouped by industry. So for example, in the healthcare industry, in the CECL, the accounts receivable disclosure, we would see those government funders, Medicaid, Medicare, separated from private pay. Again, there's always a materiality type of consideration. Um, there are unique facts and circumstances with every job and with every financial statements, but something to ask the engagement team about if this is necessary and required for the financial statements for your organization. For CECL, there are many different estimation methods that can be used. And like most things in the standards and the accounting standards, this really isn't a one size fits all approach. Every client, every organization may use a different method that's on the slide. And whatever would work better for you and make sense for your organization is what we would use to estimate the credit losses going forward as part of the standard. So the most common, I would say that we see a lot in our clients is the aging schedule. So, and this kind of method here considers the length of time a receivable has been outstanding. So it kind of puts it into those buckets of 30 days, 30 to 60 days, 60 to 90 days, 90 days, and more. And figures out, based on that schedule, what may happen, what's the supportable forecast going forward, what has happened in the past, and how can we estimate that credit loss, that allowance for credit loss on these receivables using that schedule. Another question we get a lot with the CECL standard is it okay to have a zero credit allowance? And if there's the historical data to prove that there hasn't been credit allowances in the past, so in the past 3 to 5 years, there's been really no credit losses, then maybe it is appropriate to have that zero credit allowance under the standard. But again, we really need to make sure we have the historical data to prove that that makes sense for that organization. There's a loss rate method that may be applicable with loans receivable or, different, more complex financial assets that are under the standard. So again, this standard, it really requires thoughtfulness and taking a look at what has been our past experience, what has been the experience for the past 3 to 5 years with these assets that are under scope, what's going on now. So, what are our current conditions and what is expected to happen in the future in order to recognize the credit allowance under the standard? In terms of documentation considerations, so we're auditors, we love to see documentation, and it's really important to have, just like any estimate, really good internal controls around the data and the inputs of the analysis for the Cecil model. So who's responsible for figuring out the Cecil credit balance allowance in your organization? What are the internal controls around gathering that data? And are those inputs accurate? Where are they coming from? Can we see the different documentation and supporting documentation related to those inputs? And of course, with Cecil and with pretty much all the accounting standards, there's a quantitative and there's a qualitative assessment that needs to be taken into account for the Cecil accounting standard. Another accounting standard that was just issued recently and becomes effective for fiscal years that are beginning after December 15th, 2024. So this would be right now in our 2025 year ends. So this scope here, we're talking about the crypto assets that meet the US GAAP definition of a intangible asset. And you can see here, there's a couple different requirements for what makes a crypto asset under the standard. Really kind of talking about it, it's really kind of consistent with what we'd normally think as a crypto asset. In the new standard here, we're required to measure those assets at fair value. And there are some, if there are changes in the measurement of the crypto assets, those changes would be recognized in net income during each reporting period. So you can see here, there's also some requirements if there is a remeasurement of crypto assets, there's some additional requirements to be seen here. And then also the crypto assets that are measured at fair value should be presented separately from other intangible assets in the balance sheet. So I would say crypto assets, not very common in the nonprofit organizations that we see sometimes, but they are becoming more and more prevalent. So if you do feel that you have a crypto asset, I definitely encourage you to reach out to your engagement team so that we're proactive in looking at this standard and seeing if there's any measurement or any disclosure requirements that would apply to your nonprofit organization. Just like many of the accounting standards here, we have disclosure requirements that are associated with the crypto assets. So we have, for example, a roll forward of activity for the crypto asset that is required. And then for any dispositions of the crypto assets in the reporting period, that difference between the disposal price and the cost basis, as well as a description of those activities, should be included in that disclosure. And then if there are any gains and losses, if those are not shown directly on the face of the financial statement, they should be shown in the notes as part of the disclosures to the financial statements, as well as the method for determining the cost basis of those crypto assets. So again, with any new accounting standard, definitely encourage you to reach out to your engagement team So it's better for you and for the auditor to see if there's any disclosures or reporting arrangements that would be applicable to you as a result of this standard. And that brings us to our polling question number 3. So I see there's a couple people with technical issues with the polling question. So if you have the conferences IO, so that should be a button right above the slides. Feel free to click that, and then the polling questions should show up on the side so that you would be able to answer it. For this polling question, what's your go-to snack during a busy workday? So we all need some snacks to kind of keep us going throughout the workday. So is your snack of choice coffee or tea, fruit or nuts, chips or candy, or something homemade? Myself, I'm more of a chips and candy type person. I either want something salty or something sweet during the day. But whatever your go-to snack is, make sure you hit that polling question and answer it so that you're getting your CPE today. So this section really talks about the frequently asked questions that we receive as part of not-for-profit accounting. This list really isn't all-inclusive. If you do have more questions, you can definitely reach out to me after the webinar or reach out to your Bonadio representative. Either way is totally fine. One of the questions we get every so often is, can a not-for-profit call a statement of financial position a balance sheet? And the answer is yes. Really, either term is acceptable. And in practice, both terms are used. So definitely see a balance sheet used, sometimes, and sometimes a statement of financial position. That's that statement that's in a point of time showing the assets, liability, and net assets. And in accounting, again, one of those questions that we get frequently is, what items are generally permitted to be netted on the balance sheet or on the income statement? And really, as part of accounting, very few. So a lot of the accounts and the line items are shown gross rather than net. But there are some line items that are shown net. So for example, investment return net is something that's permitted under the standards. Although there are some circumstances when the investment return is broken out as well. And tuition revenue net of aid. So that's something that for our higher education organizations that may be on the call. So that's an ASC 606 or a revenue recognition topic. And the tuition revenue net of aid is really, just shown as tuition revenue as that line item under that revenue recognition standard, because that's really what is considered to be revenue. So although it may be accounted for as net of aid, that's really what's considered to be revenue to the organization. So that's why it's shown that way on the income statement for those organizations. And for bonds and loans, if there are any issuance costs associated with those and premiums and discounts, those are netted with the bonds payable. And another question we see a lot are special events. So that is shown as net quite frequently. And then those expenses are also broken out as part of the statement of functional expenses. They're kind of brought forward over there as well. But they are netted quite frequently on the income statement as part of special events. So you can see the net revenue there. Another line item is that's net quite often that you can see on your balance sheet is fixed assets, and that's net of the depreciation as well as receivables. We were talking a lot about the CECL allowance for credit losses. So receivables are shown net of that credit allowance as well. This is another question that we receive, quite a lot. We have a lot of discussions with our clients about operating measures. So what goes in operating income versus non-operating income? What would be considered a operating revenue versus a non-operating revenue? So something to think about is what normally supports the mission of the nonprofit organization. And whatever, normally in operations, that would constitute the operating revenues and expenses and go into that operating measure. There are really very few things under generally accepted accounting principles that absolutely must be included or excluded as part of the operating measure on that income statement. And you can see there's a couple of items here that are commonly asked questions. So always included in operations, again, as part of GAAP, is the service cost component of that pension expense. So that's always included as part of operations, as well as any gain or losses on fixed assets or impairment of fixed assets that don't include discontinued operations. And outside of operations, again, part of that pension expense, this is one of those questions that is just kind of funny in GAAP, but there's a service cost component that shows up in operations, and then there's some also non-service cost components that show up outside of operations. So it does get a bit confusing in there when talking about those pension expenses. And so what are some examples? So we just talked about, GAAP really doesn't define very well what goes in operations versus what goes in non-operating activities. So what are some examples that a not-for-profit might choose to include as part of the non-operating section in the statement of activities? So an endowment is one of those activities that's perpetually restricted. So many nonprofit organizations do choose to put that activity in the non-operating section of their statement of activities. Similarly, bequests, we really can't budget for that. They come at different times. We really can't budget it. We really can't expect it. So a lot of times those bequests also show up on the non-operating section of the statement of activities. And you can see some other items here, rental revenue. If that doesn't go to the main part of the organization's mission, that may be something that is part of the non-operating section of that statement of activities. And any interest rate swaps. So a lot of nonprofit organizations do have interest rate swaps. So those gains and losses that are recognized on those swaps are normally shown in the non-operating section of the statement of activities. So that's something to be aware of. And then any foreign exchanges, gains and losses. So a lot of times those changes and those fluctuations, that variability really doesn't show up as part of the operating part of the mission of the organization. Sometimes it does, but normally it does not. And again, that would be part of the non-operating section of that statement of activities. The fair value leveling chart, we always have a lot of discussions and consultations with different clients, and it's a subject of many education opportunities, both internal and external. So just to kind of talk about what is included in each level, we get this question a lot. What's the appropriate fair value leveling for different types of investments? So first, to just give a little bit of background information, if a financial asset is measured at fair value, then it's required to be disclosed as part of the fair value leveling chart. I'm sure everybody on this call is very familiar with that chart. It's been around a lot in the financial statements for many years now. But again, it's one of those questions that we get every once in a while. So we did want to bring it up in this presentation here. So what constitutes a level 1 security? So that means you can go to the marketplace, you can go to yahoo.com, and you can find a quoted price very easily related to that asset or a liability. So what could be considered a level 1 investment? So normally that would be some kind of marketable security, those common stocks, those government treasuries, a lot of different, mutual funds could be considered a level 1 depending on the type of mutual fund it is. For a level 2 asset, for these level 2 items, there aren't necessarily quoted prices for the asset. So we can't go to yahoo.com and find the asset specifically as part of yahoo.com, but there may be some other observable inputs. There may be some other similar assets that we can value using that method. So that's the level 2. It's kind of the medium. Is it part of the market? Is it not part of the market? It's kind of on the market, but it's kind of, not quite there specifically for that asset alone. So for a level 2 investment, we would be trying to obtain interest rates or quotes for similar assets. So what would fall as part of a level 2 asset in this table? The corporate bonds normally are considered to be a level 2 asset that would fall under this table. And then certain mutual funds, if they're not easily observable as part of yahoo.com, may be in this level as well. For level 3, these are assets that are reporting at fair value, but there's really no observable market inputs. So there could be many different alternative types of investments that could be part of that level 3 fair value table. And there's also some additional disclosures that go along with a level 3 asset as well. So CDs, that's one of the instruments that a lot of nonprofits have are CDs, and we get a lot of questions, should it be part of the table? Should it not be part of the table? So CDs are kind of funny where they could be either. Just a normal CD from a bank is reported at cost plus accrued interest, and those CDs are excluded from that fair value leveling table because they're really not, they're not reported at fair value. So they're not, they wouldn't make sense to be put in that table. However, CDs can also be negotiable where there's a secondary market with larger amounts. And in that case, the CD may have a quoted market price, and normally it would be considered a level 2. But just a normal CD from a bank, that's usually reported at cost plus accrued interest. And again, that would be excluded from the table. There are some investments that report at net asset value. So that would be considered a different type of investment, like, for example, an investment in LLC or partnerships. And GAAP has a practical expedient that allows those types of assets that are reported at net asset value to be excluded as part of the table and reported separately using that method. Another question we get frequently is the makeup of how net asset classes are broken up on the balance sheet. So we do have the ability to break up those net asset classes in more detail. So they could have more detail like net assets with donor restrictions that are perpetual in nature versus net assets with donor restrictions which are not perpetual in nature. So we do have that ability to show the different net asset classes on the balance sheet in more detail or in less detail. And again, that's really a personal decision. What makes sense for your organization? That's something that you should talk about internally with the board, with your auditors, with your engagement teams to figure out what is right for you. Sometimes more detail is just seems like too much. It seems like it's just kind of muddying up the waters a little bit on that statement of financial position. And that information can be disclosed as well in the notes if it's not shown directly right on the face of the statement of financial position. So again, a personal decision in order to figure out what's best for you in reporting those net asset classes. Another question we get a lot has to do with those CDs or treasury notes. So is a CD or treasury note that is due in less than 3 months from year end considered a cash equivalent? And it's an auditor's favorite answer. It depends, right? It depends. So we need to look at the facts more clearly with the CD or the treasury note. So if the maturity is less than 3 months or less from that date of acquisition. So if an organization purchased a CD in January and the maturity is in March, then it would be considered a cash equivalent. If it's more than 3 months, it would likely be considered a investment. There there is a category of property, plant and equipment or fixed assets that are held for sale in certain situations. So GAAP has a list of criteria that has to be met in order to separate the property, plant and equipment that is held for sale. So there's a list of 4 or 5 items, but if you believe that that list applies to your organization at year end, you have a lot of fixed assets that are going to be sold and there's a buyer that's already been identified at year end. Definitely that's something to bring up with your engagement team to be proactive about, as there are different reporting requirements. So it's displayed separately on the balance sheet and it would not be depreciated as well. And that brings us to polling question number 4. So which productivity hack do you swear by? Time blocking, to-do lists, or do you just dive in and figure it out? And again, just pull up that conferences IO and make sure you're choosing something right on there to make sure you get CPE for this. I'm a to-do list person myself. I always have a to-do list. I like crossing things off. Makes me feel very productive. So that's what I do. But what do you do? And thank you so much for your time and attention today. I'm definitely looking forward to hearing any thoughts and questions that you have at the end of this presentation. Please feel free to reach out to me. Please feel free to reach out to your Bonadio engagement team with any questions. Again, the presentation materials will be sent to you within around 2 weeks after today's presentation. And as a reminder, you can still register for future sessions by clicking on the link in the chat. So have a great day, everyone. Thank you so much for joining us. And again, if you have any questions, please feel free to reach out.